Hello, everybody, and welcome to the very first episode of the Standen Standard, a brand new financial and investing show here on YouTube with your host, Phil Standen. Now, I am an anesthesiologist by day, but it is safe to say that over the last couple of years, I have become obsessed with the economy, with financial markets, and what it all means for us as retail investors. And it all started when I went to medical school. I finally graduated and I found that I had been riddled with hundreds of thousands of dollars worth of student loan debt. And when I came out into the workforce and actually started making good money, not only did I have to start paying that back, but I also found that I was paying an exorbitant amount of tax and that I would have to plan for my financial future. And so that catalyzed my interest in the economy, in interest rates, in the Fed, the Treasury, the intermingling and the interconnectedness and the total fragility of the monetary system. And so that started me on my journey. And that is why now I am starting the Standen Standard. So on this very, very first episode, we're going to dive into a bubble that I believe doesn't get nearly enough fanfare and doesn't get nearly as much attention as it should. And that bubble is the education bubble. All right, so let's get into it, guys. So just going to blow this up here. So this chart goes from almost present day to about 2006 in the top right corner. So this education bubble that I'm talking about, we're looking at almost 1.78 trillion with a T, trillion dollars. That is massive. And to give you guys some perspective on just how large that is, us student loan borrowers, approximately 43 million of us, we owe more than the entire GDP of our northern neighbor, Canada. I just want that to sink in with you guys for just a second. We owe more, the student loan borrowers of the United States, than the entire productive capacity of our northern neighbor, Canada. It's absolutely astounding. So here, I've got a couple of circles down here. You can see in 2008, we're almost just over 500 billion at 0.68. This is the great financial crisis, great crash. It was a subprime mortgage frenzy. People lose their jobs. There's crash. What do? People go back to school. They start bidding up the price of tuition because that increased demand is there. And with the great financial crisis, a lot of these higher education, these colleges lost their subsidies from the government. So they passed that cost on to the consumer, or in this situation, the borrower. Okay. This grows and grows and grows pretty insidiously, not exponential by any point. And then the second one here I have circled is 2020. And everybody knows what happened in 2020, especially me. I remember being in residency in the last 3 months. I graduated in June. So March to June, it was absolutely crazy. And people lost their livelihoods, people lost their jobs, and in some instances, people lost their lives. And in response to this, the government came up with a couple of programs. So the first was a forbearance program that started in March of 2020 and continued until about September of 2023, with repayments starting in October of 23. We'll get to that in just a second. And then the responses from the government included ZIRP, which is zero interest rate policy. So if any of you recall, that just basically means that the Federal Reserve slashed interest rates short term to almost zero, and then had that reflected in the almost historically low 30-year fixed mortgage rate of around 2.5% to 3%. And then also the government installed these massive trillions of dollars worth of mortgage-backed security purchases to inflate demand. And we'll get into that a little later in the video. So back to these delinquencies, guys. So here, what you're looking at pre-COVID, what I want to highlight here is that it was about 13 to 14% of serious delinquencies. And the serious delinquencies here, they are highlighted or defined, as 90 plus days. So basically it's taking 3 months of no payments. Then you can see here in 2020 in Q1, when COVID hit, almost a Wile E. Coyote moment right off the side of a cliff, almost all the way down, goes to 6%, then goes all the way to almost zero. Now, why is this? Is this because all of a sudden all of these student loan borrowers became fiscally responsible and started paying back these loans? No, it's not. It's because of this forbearance program that made it so the reporters required that they reported all of these borrowers as being current when they actually weren't. And they were able to forbear their payments and push the can down the road. Now, as you can see on the right side of this chart, in 2023, in October of 23, the payments started shooting back up. There's a ramp up period, and I don't even really know what that means. But the point is, guys, that now you're starting to see this exponential increase in the percentage of student loan borrowers that are seriously delinquent. And this has a lot of ripple effects for the real economy, which I'm going to show you here in just a second. This is another display that just shows from about 2004 all the way up to 2020, anywhere from 6 to 12% growth in the outstanding student loans, and basically went to almost zero, 1 to 2%. So really stayed stagnant after COVID, which kind of denotes and kind of highlights the decrease in the delinquencies that are being reported. Excuse me, went back. So what are the sectors that are going to take a hit from these increased delinquencies? So first one is auto. If you can imagine, folks coming out in their 20s and 30s, they're becoming increasingly delinquent. Their credit score starts to take a hit. And this really has a nice display of these individuals that from 2003 to 2025, really all it's showing is that as your credit score goes down, there's less chance that you're going to be able to get access to financing for auto loans. And this shows up as exposure in these companies. Some of these companies such as Tesla, Honda, Kia, Hyundai, all these cars that you see all the time, these enormous companies that sell cars here in the United States, they are most likely, in my opinion, going to feel a lot of pressure in late 2025 into 2026 because of this consumer base that is going to have a reduced ability to be able to get financing, or will be completely cut out because their credit scores are going to take such a hit. And here on this next slide, guys, I just wanted to highlight some ETFs. I'm not going to read all of this. If you want to, please pause the video, take a picture, and do your own research. These ETFs are essentially vehicles that pool together many, many companies. And they are the primary vehicles of individuals that have index funds, that may have 401ks, and they have passive funds that go into these ETFs. I, for one, I'm not a financial advisor, so I would never give financial advice, but I do not invest in these ETFs primarily for this reason, because I see there's going to be a lot of headwinds and a lot of issues with these companies down the line because of these consumers having reduced access to credit. The next sector that is very, very sensitive to this discretionary inability to garner financing is housing-related retail. So IKEA, Williams-Sonoma, these companies whereby Best Buy, if you're going to buy a refrigerator, you're going to buy a washer, dryer, these are very dependent on large ticket purchases that require financing. So again, guys, as these scores go down because of the increased delinquencies, you're going to see a lot of these consumers that they're not going to be able to spend out in the real economy. And to a lesser extent, I just wanted to share another couple of sectors that I believe will see some weakness. I just highlighted their tickers as well. As you can see, these are widely traded on the New York Stock Exchange, NASDAQ, Expedia, MGM. Individuals that all of a sudden now they have to start paying these loans back, or they go into default and their wages get garnished. They're not going to be able to go on that trip. Okay. They're not going to be able to go on that cruise. Discretionary retail, that's the next thing that will take a hit. So you're not going to get those Nikes. Maybe you're going to get a cheaper version of the Lululemons. Okay. Ross Dress for Less. You get the picture. And here I really just wanted to kind of bring it all together. And here on the right top, basically automobiles and housing retail, more the big ticket items are really going to be sensitive, and the companies that sell them to this credit squeeze because of these increased delinquencies and decreased credit scores. And then down below we have travel and discretionary. So now moving on, we talked about the forbearance of the student loan borrowers. Now we're going to talk about the response of the government. Okay. So zero interest rate policy. So remember I talked at the beginning of the video, Fed slashes interest rates to almost zero. As you can see here, it mentions here at the bottom, they had this massive trillions of dollars of purchases worth of mortgage-backed securities. And what did this do? What this did is essentially it slashed, or rather pushed down, long-term 30-year mortgage rates to a near precedented historic low of around 2.5 to 3%. And from the left to right, you can see that back from 1980, where the interest rate was almost 18%. And now, just post-COVID, compared to the historical average of around 7.7%, you had these interest rates that were now 2.5% to 3%. So extremely low and less than half the historical average. This, from the consumer standpoint, caused a huge boom, not only in primary purchases, but also in refinances. And what this shows here, this is a really nice chart. It shows that for FICO scores less than 700, there really wasn't that much of an increase in finances. But if you had really good credit scores, which a lot of individuals that were going through these forbearance programs did, erroneously, I might add, they were able to lock in these Goldilocks interest rates at these new refinance rates. So you can see from the consumer standpoint, this inflated and artificial demand that led to this boom. And here from the government standpoint, this just shows that the increase in the amount of mortgage-backed securities that were purchased through Fannie and Freddie government-sponsored entities really increased and spiked after 2020, and then has come down through the ensuing years as interest rates have risen. And also from the government standpoint, the forbearance for individuals that already had these mortgages, it was for individuals that already had these federally backed loans, Fannie, Freddie, from 12 months up to 18 months. And they also had credit protection, which means they could not have any delinquencies, or rather no delinquencies were reported for 2021. And these three prongs of zero interest rate policy, these massive buybacks, and to a lesser extent, the forbearance really helped prop up and add to this real estate bubble that we are now in, okay? And this is where the connect comes from the individuals who are now going in from delinquency in the student loans, now going to default. So the HEROES Act, I'm not going to go too much into detail on that, but it was essentially an act for student loan borrowers that extended payments until 2023. Now we have all these phantom obligations that were not being reported as delinquent. And this is why we care about this, guys. This is why it's such a big deal, because for almost 2 years, the housing market has functioned as if all of these borrowers were way more creditworthy than they actually were. So all of this demand, in my view, is fake. And this is really trying to tie it all in together for you guys. So remember, we talked about delinquencies being 90 plus days delinquent. Going into default is 9 months or 270 days. As that's occurring, your credit scores are already taking a hit. Then these credit screeners for Fannie and Freddie, they will disqualify you if you have a default. And why this is important is, of the $55 trillion housing market, approximately 70%, 70% is made up of these government sponsored entities. So essentially they comprise almost 3/4 of the housing market. And this is going to culminate, in my view, in fragile housing demand, especially in starter homes. So let's do some math real quick. Remember at the beginning of the video, I talked about the approximately 43 million borrowers, myself included, that owe almost $1.8 trillion in student loan debt. Now, remember the delinquencies were going up at around 10%, but they were going up exponentially. And some data I've seen shows that it's almost closer to 20%. So if we take 20% of 43 million, that's around 8.5 delinquent borrowers. And if we assume, being conservative, approximately 5% of those borrowers want to purchase a home for the first time, it's actually around 425,000, but I just rounded it up to 500,000 to make the math easy. Last year, there were approximately 5 million transactions between new and existing homes. So if you take those 500,000 first-time borrowers that can no longer transact, you're stripping 10% of that demand, or 10% of those borrowers from the market. So the entry-level demand gets sliced by that 10%. And this is where we have to brace for impact. I'm not saying there's going to be a housing crash. What I am saying is that in my view, from late 2025 into 2026, we're definitely going to see some downward pressure on entry-level homes, especially in the $350,000 to $400,000 range. All of these builders, they're going to have to start giving incentives. They're going to have to try to decrease the rates. They're going to help with closing costs to try to move this inventory. And remember, guys, this is against the backdrop of an already fracturing housing market. We have over 500,000 homes on inventory now, which I believe, don't quote me on this, but I believe it's higher than in great financial crisis levels. All right. So that's starting to show that there are distressed sellers in the market. And why is that? We've been talking about mortgage rates for most of this video, but even if those mortgage rates stay at 3%, guess what continues to go up? It's taxes, it's insurance. After the Palisade fires, insurance across the board went up almost 40%. You've got maintenance. If you've got an ARM, you may have interest expense, right? All of this is against the backdrop of this already weak housing market, in my view. Construction jobs. So the builders pull back, construction jobs go down, people are losing their jobs or there are less hours to work. This ties back into Home Depot. This ties back into Lowe's. These individuals aren't buying nearly as many tools anymore. The move-in ecosystem, really important. Home improvement, paint, anything else that you're doing to your house. These companies, furniture, these companies that sell these products are really going to take a hit. And we need to be vigilant as investors and make sure if we do have exposure to these companies that I've talked about earlier, that we manage our risk accordingly. And the housing ladder for first-time home buyers, as they buy a home, that may potentially allow the seller to move up into another home. And this, for most folks in their 20s and 30s, especially now, if you get out into the job market, there's not as many jobs. There's been widespread debasement of the currency, which means your purchasing power, your oil, your gas, your food, your medications. Most of these people, I would argue, their only chance of wealth is either to go really far out the risk curve, whether that's in commercial real estate, crypto, Bitcoin, etc., or try to get into the housing market and hopefully get those appreciation gains. Okay. So that is kind of the culmination of what I believe is going to occur, going from these student delinquencies to these defaults rippling into the housing market. And really interestingly, guys, historically, the home purchase triggers about $4,000 to $6,000 worth of purchases in business per home. You multiply that by about the 500,000, and it shows here 2 to 3 billion in demand removed. So to tie it all home, guys, the student loan delinquencies, lower credit due to the higher delinquencies is going to have fewer buyers. You're going to see these less discretionary spending. That's all going to culminate in weaker demand in those discretionary sectors that we discussed, and the fragile housing market, especially at the lower end, which may cause lower prices, decreased jobs, and decreased wealth effect for these individuals trying to get into these homes. So with that being said, guys, this is the end of the very first video of the Standen Standard. I hope this was informative. I hope that it was thought-provoking. And as always, stay informed, stay vigilant, and I can't wait for the next episode. See you soon.